So you've built wealth across a bunch of different accounts. Maybe an RSP that's now turned into a RRIF, a solid TFSA, some real estate, a corporately owned investment account, maybe even a pension or life income fund known as a LIF from an old job. But now that retirement's here or around the corner, the question becomes, which account do you pull from first? That one decision, it can literally save you thousands or quietly cost you the same. Because not all withdrawals are taxed the same. Some trigger clawbacks, some don't show up on your tax return at all. In this video, I'll walk through the different type of accounts, RRIFs, LIFs, TFSAs, non-registered corporate accounts, and help you figure out the smartest order to draw your income in retirement. The goal? Make your money last longer, pay less tax, and avoid mistakes that quietly erode everything that you've built. If you're new to my channel, welcome. I'm Jacqueline Ozdemir, a financial advisor at Ferguson Financial Planning. I spend my days helping people take complex financial situations and turn them into something that actually works, something that builds wealth over time instead of bleeding it out through taxes, inefficiency, or poor timing. And today, I'm going to talk about one of the silent wealth killers that I see all the time, poor withdrawal sequencing. It's rarely talked about, but choosing the wrong account at the wrong time can cost you more than a bad year in the markets. I'll cover the importance of your withdrawal order, how to smartly juggle RRIFs and LIFs, tap into TFSAs and non-registered accounts, and how to time corporate dividends just right. If you end up finding this helpful, please hit like, leave a comment below to share your thoughts or questions, and subscribe to the channel so you don't miss a future video. Let's start by talking about the big picture, why your account order matters. If you've got multiple pools of savings like a RRIF, a LIF, a TFSA, maybe an open investment account, or even a chunk of cash in a company, figuring out which to draw from first isn't always obvious. It seems easy at first glance. You need money, so you pull it from wherever. But in retirement, that choice can have a ripple effect that follows you for decades. Think of a garden with different plants, each needing water at specific times, in just the right amounts. If you overwater one area, you risk runoff and wasted resources. If you underwater another, it withers. In retirement, each account has its own tax treatment and withdrawal rules. Overshoot one, and you might face a bigger tax bill or reduced benefits like old age security. Undershoot another, and you may miss out on growth or scramble to cover your expenses. I'll give you a small example. I once met with an individual who focused only on draining his RRIF early because that was the first thing on his mind. He ended up crossing over the old age security recovery tax line, which is about $90,000 of income, so he lost his old age security. It was clawed back. He was understandably frustrated. A little advanced planning could have shifted part of his withdrawal to his TFSA or non-registered account and kept him below that $90,000 mark in CRA's eyes. So what's the lesson here? Sequence matters. Just like that carefully tended to garden, retirement accounts each play a distinct role, and a bit of planning can help you keep more of your wealth in your hands. Next up, RRIFs and LIFs. Unlike TFSAs or open accounts, you don't always get full freedom on how much or how little you withdraw. You must convert an RSP to a RRIF by December 31st of the year you turn 71, and then beginning at age 72, the government forces out at least the prescribed minimum, which is 5.4% of the prior year's balance. This percentage grows too as you get older. A LIF, which comes from pension money, has both a minimum and a maximum allowed withdrawal. That's a big deal because all these withdrawals get added to your taxable income. If you pull too much, it can bump you up into a higher tax bracket, which might claw back old age security or other government benefits. If you pull too little, well, you're stuck with the mandatory minimum anyways, and it may not match your actual needs. Let's look at Sarah, who's age 72. She has a LIF shaped by old pension rules plus smaller streams of income elsewhere. She could take the maximum from her LIF each year. Some do, thinking it's easier to just empty it out. But too much LIF income can drive her total taxable income upwards. That means a chunk of her OAS might evaporate. And if she doesn't actually need all that money right away, What's the point of hitting a bigger tax bracket and losing out on tax-deferred growth? On the flip side, if you see a low income year coming up, you can use that year to withdraw a bit more from your RRIF or LIF, taking advantage of a lower tax bracket in a particular calendar year. The trick is to coordinate these moves with other accounts to avoid sudden tax spikes. In short, handle RRIFs and LIFs with mindfulness and balance so forced withdrawals don't cause bigger problems down the road. TFSAs and open non-registered accounts, keeping your tax bracket in control. Now let's turn to tax-free savings accounts, or TFSAs. There are no forced withdrawals, and anything you take out is completely absent from your tax return. So tapping into it for a big trip or renovation won't raise your marginal rate or jeopardize benefits. Even better, whatever you withdraw this year is added back to your contribution room on January 1st of the following year. So a late December withdrawal can actually free up fresh room almost immediately. Meanwhile, an open account like your non-registered stock portfolio or mutual fund portfolio doesn't require mandatory withdrawals either. But you will face capital gains taxes if you sell at a profit. On the good side, as it stands now, capital gains in Canada are only taxed on half of the gain, and eligible dividends often come with a dividend tax credit. That's a bit friendlier than the fully taxed RRIF or LIF withdrawals, which are taxed as income, but it's still taxable. So you need to have a thoughtful approach. Let me share a story about Priya, who's in her mid-60s. She has a modest RRIF and a fully stocked TFSA, plus an open account that's grown nicely over the years. Priya uses her RRIF to cover the basics, draws small amounts from her open account, which is mostly dividend income, and then draws from her TFSA whenever there's a bigger expense, like maybe she's helping her granddaughter with university or taking a special trip. By doing this, she keeps her reported income consistent, staying out of the brackets that risk losing old age security. The key is not ignoring the TFSA. It's not just for emergencies, it's a powerful lever to smooth out your taxable income. So without a plan, you might end up paying more tax than needed or missing simpler, cleaner ways to finance your life. Now, if you own a business or practice, maybe you work inside a professional corporation or have an investment holding company, your corporate account brings another piece to this puzzle. Money inside your corporation might enjoy lower tax rates on business income than you'd pay personally, but it faces its own set of tax rules. When you want funds for personal use, you must pay yourself dividends. And guess what? Those dividends become part of your personal income. That can be either a problem or an opportunity. Let's say you've built a sizable investment portfolio inside your corporation and now need cash personally. You decide to pay yourself dividends. But if you do it in a year when your RRIF withdrawals and other income already fill up your tax bracket, that extra dividend could shove you into an even higher tax bracket and even claw back your old age security. Instead, imagine spacing those dividends out, drip a set amount each year, or time a larger payment for a year when other income is light, because dividends come out as eligible or non-eligible depending on the corporate's tax pools. The gross up and credit system generally equalizes corporate taxes and personal taxes, but the timing still drives whether you pay the top marginal rate or stay in the sweet spot. Plan the payout window just like any other withdrawal, and your corporate savings works with you, not against you. Take Jill, a consultant who's retired but kept her corporation running as an investment vehicle. If she pays herself a single $100,000 dividend in the same year her RRIF withdrawals are already maxing out her bracket, she could jump into a higher tax rate and trigger OAS clawbacks. Spreading those dividends out over several years or timing a lump sum payment for a year when her mandatory RRIF minimum is smaller lets her juggle her total income and stay below key thresholds. The lesson is simple. Corporate cash isn't magically tax-free, it simply defers when and where the tax shows up. Coordinating each payment with the rest of your retirement income keeps more money working for you instead of the CRA. So how do we take these separate threads, RRIF, LIF, mandatory draws, TFSA flexibility, open account gains or dividends, and corporate investment payouts, and turn them into a tidy retirement plan? It comes down to coordination. You want to look at each upcoming year's expected income, your lifestyle needs, and any big looming expenses. Then you map out which bucket to tap into first, second, and third, aiming to stay within the optimal tax brackets. One approach is known as filling up the bracket. You project your base income sources, like a small pension or part-time earnings, and see how much room is left before you jump into a higher tax bracket. If there's, say, $15,000 of wiggle room, you could take that much from your RRIF without tipping into the next bracket. If you need more, then consider a TFSA draw, for example. Meanwhile, if you sense that you might not spend all of your open account gains in your lifetime, you could consider withdrawing a chunk earlier, especially if you're in a lower tax year, to gradually reduce a large holding that might otherwise trigger a huge tax event down the line. Think of it like planning a road trip. You check the route, watch for traffic bottlenecks, and plan your stops so you're not forced into a gas station with sky-high prices when you're running on empty. With a bit of year-by-year planning, you can avoid avoidable taxes, preserve important benefits, and stay flexible for the future. That's the magic of a properly sequenced retirement income plan. Steady living, fewer tax surprises, and better overall control. So when you glance at your retirement accounts, it's tempting to think a dollar is a dollar, but it's not that simple. Your RRIF or LIF has minimums you can't avoid. Your TFSA can save you on taxes if you use it wisely. Your open investments might carry capital gains or dividend opportunities, and a corporate account can help or hurt depending on timing. Each bucket is unique. We've seen how mandatory draws from a RRIF or LIF can push you into higher tax territory, especially if you pile on extra income from other places in the same year. You've seen that TFSAs let you pull out funds with no direct tax cost. You've heard how open accounts can be used for capital gains or dividends with some tax advantages, but still subject to annual reporting. And for business owners, corporate accounts basically shift your tax responsibilities around. If done well, you can keep more money in your pocket, but done poorly, and you might be stuck paying more tax than necessary. This matters because every retired or soon-to-be retired person wants to make the most of what they have. Taxes can be one of your biggest lifetime expenditures, second only to your home or even bigger for some. By being mindful of the order in which you draw from each account, you're effectively giving yourself a raise. You're preserving your resources, and that means more stability, more freedom, and more peace and knowing you've taken the time to do it right. So yes, retirement income planning is a bit like a puzzle, but once you see how the pieces fit together, it's surprisingly satisfying and well worth the effort. So remember, the order you draw from each of your accounts in retirement can seriously impact your total tax bill, your government benefits, and how far your money actually takes you. And remember, it's not about draining the biggest balance or picking whatever feels convenient. It's about making deliberate moves year by year that keep your income in the right tax bracket, preserve benefits like old age security, and make smart use of each account's strengths. And if anything in this video made you think, wait, am I doing this right? You're not alone. Sequencing your withdrawals isn't flashy, but it's one of the smartest financial moves you can make in retirement. If you've got a question about how your own accounts should come into play, drop it in the comments or feel free to contact me through the links in the video description. And if you're thinking, this sounds like something I should be planning now, then let's talk. There's a link in the description to book a quick call, and I can see how all of this could apply to your situation. If this was helpful, hit that like button, subscribe, and tap the bell so you don't miss what's coming next. I cover this stuff in plain English, always with your long-term goals in mind. Thanks for watching, and I'll see you in the next one.